Alright, so welcome back to FFTVC, and now we are going to also check for the reliability of our strategy in finding entries for the week. So for the beginning of the week, when trading the swings, you can use our standard momentum strategy to find a good entry for the week. And so we're going to show you how to identify good entry potentials for every week. Now, one thing stands out, same check as we do when trading intraday is also the same check we do when trading swings with the standard momentum strategy. So for intraday, again, we use the mini momentum strategy, and now for swings, we use the standard momentum strategy. So the first thing we check is how average price is respected or responded to in every case, so that we use average price as a determinant for where our entry will be for the week. And momentum is of course generated by average price. So wherever average price is found, there we'll see momentum when price reacts to average price. So without trading support and resistance, without trading any other technical consideration, we use purely average price to generate momentum and place our entries for the week. So now the time frame for swings with the momentum trading strategy is a 4 hours time frame, and again our specialty financial instrument is volatility 75 index, because here as FFTVC we focus on 24/7 trading of volatility 75 index, and so we live stream our trading content to show you how we place our entries and what we are trading, when we are trading, how long we hold our positions, and when we exit our positions. Now, because we are using our proprietary momentum trading strategy, we are able to trade dynamically. We can trade flexibly with either the swings with the standard momentum, or we are trading intraday with the mini momentum, or we are trading scalping with the micro momentum. So we are able to generate regular signals for everyone who is connected with us as a subscriber on our YouTube channel at FFTVC, and also is a member of our trading group, our public group on Telegram at FFTVC. And also for those who are members of our trading community, that also contribute to the sustainability of our live streaming content on YouTube, and also our localization of our channel on mainstream satellite cable channels. Then we have our private uh, trading community also for them, those who sign up on our website and help us to grow by contributing a quota of 50% of their trading profit share from using our strategy every week. So we teach others who want to do this on their own. So if you want to do it yourself, then you can learn how to trade this momentum strategy from wherever you are. So right now we are trading on 29th of May, and we are trading at the last day of the week before the beginning of a new week. So we're going to use this same standard momentum strategy to determine the new trend bias for the new week. And so because the week is going to be setting off in about 4 hours from now, we can show you accurately how we determine the bias for our entry for the week, one position that gives us the right amount of profit. Now, in measuring our profit targets, there are over 150,000 points of profit to be captured in a week when you find the right entry using this strategy. And for 150,000 points of profit, that gives you an average weekly income of if you are trading a $10 account, that's a position with a 1 nano lot, that's 0.001 trading volatility 75 index with the least risk exposure, that's the minimum lot size of 0.001, then 150,000 points is equally $150. So if you run 3 positions for the week on the same entry using our micro momentum trading strategy to determine the entry, that gives you $450 a week. So minimum of $450 a week if you had your position set for the week, and that's the importance of trading this. So no matter the size of your account, you can consistently make $450 weekly trading micro momentum or trading standard momentum strategy with a swing trading strategy in place. So that tells you the importance of this. And then to mix it up with our daily strategies, you can also increase your profits by an additional $450. That gives you $900 a week. That when trading intraday, mix up with swings and also mix up with scalping. So over $1,000 a week. So an average income for the month will be over $3,000 average minimum income for the month. That's the reliability and profitability of our micro momentum trading strategy, a proprietary trading strategy developed by FFTVC. And so, members of our trading community who make profit using our strategy can also promote us to their friends by sharing their testimonials on Twitter, hashtagging FFTVC on Twitter. By doing so, they get their friends to know that we help them generate consistent weekly profit from the market. And you too, if you are not subscribed on our channel, you can subscribe here on YouTube at FFTVC and also on our public channel on Telegram at FFTVC. Alright, so let's get back to what we are trading and why we are doing this analysis. You can get to see how we generate our entry. So this is an important part of your training on trading. FFTVC's favorite specialty instrument, volatility 75 index, and the strategy was developed exclusively for volatility 75 index but can apply to all other financial instruments that you can trade. Alright, so well, for consistency purpose, apply this to the highest volatile instrument in the financial market, and that is volatility 75 index. So let's check first for consistency of average price, which stands as a critical factor for determining momentum. And with momentum, you can tell the trend, and with the trend, you can also place an entry for the week. All right, so we use the 4 hours time frame, and we check for consistency of how price after the initial opening of the week's candle, 4 hours candle, how price reacts to average price of the opening candle. Okay, so that will tell you also the bias for the week. So let's see. All right, so we take a backward step to look at this. Okay, so this is on 21st of March. On this week of the 21st of March, average price was set at 650, and in the first 4 hours you see that average price was reacted to, and because there was a bounce and no penetration of average price, market stayed above average price all day from that covered from average price up to the high here, that covered 126,000 points of profits in the week. 126,000 points of profit in the week. So that was that. Then the next week, average price was at 764. That is for the week of March 28th. The week starting on March 28th. So average price was at 765, and the first reaction was a down reaction by the first 4 hours candle, and there were a series of reactions. So within this week, you could trade the first penetration of average price, and the minimum profit you make here is 27,000 points. Then again, after the second bounce on average price, you make another 47,000 points. And lastly, again, after the bounce on average price, average price here, after the bounce on average price again, you make another 20. Okay, you have 4 times bounces on average price. You have the first 28,000 points. Then bounce on average price, you have another 46,000 points. Then bounce on average price, you have another 39,000 points. Then bounce on average price. Okay, average price was broken downward, so you trade downward again. You have another 38,000 points. Then return to average price and break from average price. You have another 30. You have another 25,000 points. So put together, you have over 100,000 points traded for the week using only average price as a determinant for your entry of the week. So you could trade 4 times, 4 sessions this week. One for the first bounce, 2 for the second bounce, 3 for the third bounce, then breakdown, 4 and 5. So 5 sessions for the week for all bounces on average price. So that takes us to the next week, starting on 4th of April. Average price at 749. So the first move down of average price gave you 30,000 points, and another move again after the bounce downward gave you 37,000 points, and then average price was broken, and the next move gave you 60,000 points, average price again a bounce, and the next move before the week ended gave you 73,000 points. So putting all together, you've got over 150,000 points for the week. So let's see again for the next week of April, starting on the 11th of April. The week started with the first bounce on average price. So average price here at 815. Average price at 815. So as the week starts, 815. The first reaction to average price was the first H4 candle, and that signaled a buy. So you bought above average price and you captured the first 76,000 points. The market returned to average price and broke downward, so you trade downward. Another 47,000 points. Market returns above average price, and if you traded that, you got 10,000 points. Market return below average price, and if you traded that, you make an extra 51,000 points, and that was it. Market return to average price. Then again, the market of so you trade again the market of 18th of April. Average price set at 84 as 804. The first down move below average price, you captured 32,000 points. The market returned to average price, rejected average price, came down again to 15,000 points, returned to average price, broke average price, and there you traded all the way up, no return again to average price. all the way up to 103,000 points. So put all together, that's about 50,000 points still captured for the week. So all the way up. So average price again was seen at play for the week. Then for the next week of the market on starting on 25th of April. 25th of April, average price at 905. So what happens here? Okay, 905. The first move for average price, you could have traded 23,000 points, then bounce from average price again. You trade at 30,000 points, then return to average price and broke upward. You trade another 20,000 points. Again, downward of average price, you trade another 28,000 points, return to average price and bounce again. You trade another downward, 49,000 points, back to average price again, and now broke average price upward. You trade all the way up to 132,000 points. So put all together, you have an average of 150,000 points traded, all with average price at play for the week. Again, average price for the market of 2nd of May, average price is at 988. Average price at 988. The first move above average price gave you 47,000 points, and the average price was broken downward. You traded 25,000 points. Average price again was rejected, and you traded another 25,000 points. Average price again was rejected downward, and you traded all the way down to 73,000 points. Then back to average price. Average price was broken, and you joined the market upward. No reach at average price, so you held position all the way up to 166,000 points. So above your profit expectation for the week, 166,000 points. So if you added all of this, it's over 200,000 points. For if you traded all the rejections, all the corrections, and upward, so that would be over 200,000 points of profit for the week. Then again, the market of the week starting on 9th of May, average price was at 112. Now the first candle away from average price, no further attempt at reaching average price, so you traded all the way down to 121,000 points, 127,000 points, no reach at average price. Again, for the market of so 27,000 points there for the week. And again, for the market of 16th of May, average price at 105. The first H4 candle reacted to average price and could not close above average price. So downward, you traded the closing of the first candle that reacted to average price downward all the way down, no rejection, so you made 140,000 points of profits. Then the next week again becomes this very last week for which we are in the market, an average price for the week starting on 23rd of May. Average price was at 927, 926. Okay, so yeah, yeah. So average price at 928. You trade the first rejection of average price. So if you saw the bounce on average price and the rejection, and you traded the bounce, you would have okay, you either would have traded this upward or ignored it totally. But if you traded it, that would have been first 20,000 points, and next follows average price was attacked and broken, and you traded another 41,000 points. Average price again was rejected, and no, the only closing here was below average price, so you are selling, and you traded another 10,000 points. Average price was at rejected again, and all closing below average price is sell, so you sell again and you sell again, so continuously you sell down to 25,000 points. Average price again was rejected, and you sell from that rejection because the next closing below average price you sell, so you sell again down to 28,000 points, and average price again was rejected. Closing below average price you sell again down to all the way down to 144,000 points. And right now we are about the closing of this week, so you should see that average price has been the principal focus of the market for the weeks looked at or studied. Average price had been determinant for the momentum, so average price becomes what price engages with to generate momentum for the next move. So if you identify average price to trade the standard momentum strategy, it means you want to take your first entry for the week. That will help you or guide you or serve as a compass for you to trade throughout the week. And the minimum profit target you have seen here is an average of 150,000 points of profit, of which if you trade 3 positions with it, that's with a $50 minimum account, trading one nano lot 0.001 lot size, you have a consistent ability to generate 100, that's $150 per trade. That's over $450 per week. So $450 per week is consistent when trading the standard momentum using average price as a determinant for momentum, and using momentum here represents your bias for entry when price reacts to average price. So wherever price closes in reaction to or relation to average price for the week is an indication for your sell or buy. So if you look back again, you see that wherever price closes, if above average price, then you can either sell on the next candle or buy on the next candle. Okay, so let's validate this and see if there have been consistency for the weeks. And if you need to trade the standard momentum strategy as a swings trader, then pay attention to this. Let's back test and see how consistent this has been. We pick a day, and on this week starting on the 20th of September 2020, so we're looking far back as 2020, and let's see consistency. So average price was rejected, and look at the first. Okay, average price first has to be engaged. When you determine average price at 448, so 448, let's see what happens. Okay, 448. Now, where does price close? The first attack or confrontation or engagement of average price determines your trading for the week, the first trading for the week. Price closes below average price, so it means you should sell. So if you sold here, of course, the market tries to go back to average price. So let's place average price where it should be. Average price, yeah, okay. So average price at 448. Now the market closes below average price, so you sell on the next candle. So you sell on the opening of this candle, and you sold here, and the market went to test average price. Now your stop loss would be 3,000 points, 3,000 points below average price. So 3,000 points below average price would be your stop loss. So that should be 451. Yeah, 451. That, so your stop loss is protected from whatever the market does here. Now average price was retested and rejected, so your sell position is still open, and your take profits can be as far as 20,000 to 40,000, as the case may be. So here, the first 40,000 points of profit you held, and you took profit here. Now average price was not approached again, so you could have found a new entry here. So we teach you how to also find a new entry if you find a rejection, how to find a new entry downward and trade again on the bounce. So either bounce on average price or bounce elsewhere on any candle. So for this, you sell since you've noticed that average price has not been approached. You can still sell the market here if you don't see any sign for buying. So here, what's the sign for selling again? There is a rejection of a low, and that means you can sell on the average price of this candle you sold here. Okay, so at the rejection you close on profit, and then again the market goes back upward, and you see the rejection. When the market closes, you see the next candle's rejection. You can now sell again on the next candle when you see the rejection, and you sold again down. Average price is still there, and the next. So you can see average price throughout this week was only engaged once, so that gave you your entry, because the first candle that engaged average price closed below average price, so you sell. Okay, so we move to the next week of September, and here we identify average price at for the week of 27th of September 2020. Average price was at 419. So we look at the first engagement of average price and where price closes. Okay, so first engagement of average price was a rejection, and price closes below average price, so you sold here. And okay, in this case, when you sold, the market opened, and sure, you sold on this green candle. It came down, made a high, a small high, and rejected the high and returned back to average price. Now your stop loss is 3,000 points from average price, and that was your stop loss. Your stop loss was taken out, but all the same, you always move stop loss to average price so you can re-enter on the bounce. So safely, how to trade this strategy is when you have placed an entry above average price, your first stop loss must go 1000 pip below average price if selling, or 1000 pips above average price if buying, so as to protect your profits and allow the market to either bounce off average price or break average price. Then you gain. Wherever the market closes, you buy. All right, so here the market makes it to break average price, and you bought at 3000 points. 3000 points here. You bought from average price up there. That was 17,000 points, and there was a rejection. So there was a rejection, and here you sold below the average price of this very candle. You sold downward and back to average price. So at average price you take profit again, and continue to watch rejection of average price here. So you are most likely to want to sell again, and this here could have created some conflict, strong reaction to average price, as you can see, all through. And finally you found an opportunity. You could have sold here and made some profit again, or okay, yeah, you would have bought here and made some profit above average price, or sold here and made some profit below average price. So the full bodied candle closing here gives opportunity to sell. Full bodied candle closing below average price or above average price gives opportunity to buy. So if you bought here, your take profit would be somewhere here, or your SL will be somewhere above average price too, so you don't come out of loss, or with loss rather. And again, average price is broken, and of course it closes here, so you sell on the next candle. And if you sold here, your take profit is here. So market goes up, picks you into the market, and you took some profit. And again, average price is reacted to, so you buy here above average price, you buy. And sure, here you bought all the way up, all the way up 75,000 points, and that was the last time average price was engaged for the week. Then again for the week starting on 4th of October, you identified average price at 465, average price at 465. So the first time the market engages average price and rejects average price, closing below average price gives an opportunity to sell. So when you sell here on the opening of the next candle, market makes a little high, you set your take profit here. Okay, yeah, so in this case you are selling, and the market comes to take you out just below average price. So and the next candle again, since the market closes below average price, you are going to sell again. So you sell again, the market takes you out here, and you sell again, it closes below average price, so you sell again. So this time you are in profit by 19,000 points. And if you held on, or you decided to close on this rejection, you could still trade on. Alright, so but there are reasons why you would want to hold further, believing in your profitability, and you move your SL upward until your SL hits. So that's basically how we trade this. And then again, market goes, avoids average price altogether, and comes back up, another 61,000 points of profit. So all of this, you see, average price is the determinant of momentum, creates the liquidity zone for each week, each day of the week. So looking again at the opening price here for the market of 11th of October 2019, average price was engaged firstly. First average price was 406, average price was engaged, and closing above average price, you trade on the next candle that opens, you buy. So you bought all the way up, and sold around here. So you sold to close, and the market returns back to test average price. So every time market rejects average price and closes above average price, you buy. So you bought again, and there is a rejection, you close. Market comes again, rejects average price, closes above average price, you buy, and again you close. Market comes again, rejects average price, and of course closes above average price, you buy on the opening of the next candle. So you buy again, market comes, and this time breaks average price, and you sold downward, and all the same. So average price engaging back and forth, and whether the trend is clearly strong or weak or sideways, you can trade comfortably with average price and make profits. So for the next week, when the trend is strong for the week, you make good profit. When the trend is not strong, also you use combined strategy to make profits. Then again, for the week of 18th of October, for the week of 18th of October, average price was identified at 416. So what's that? Okay, so the first candle closes below average price on the opening of the next candle. So you sold here all the way down here. You sold, and the market goes down back to average price, and the first rejection here, market is below average price. So you were to sell on this next candle, but this candle did not sell, and sure, upward radar broke average price and closed above average price. So you would have bought again on this candle, closing, opening above average price. But what happens next again? Market returns. Alright, so when this happens, where market does back and forth journey through average price, you know that something isn't right here, and you just have to trade with caution. So the market doesn't correspond with your projection always. So by minimizing your risk exposure, setting your stop loss, you can always minimize the number of times you lose at such times when the market is not clearly ready to move away from average price. When the market is closer to average price throughout the week, it's a bit risky. Okay, so you traded again here, market close below average price, you know you are selling, and as you sold there, market moves a bit this short distance downward, and again bought upward to average price. So such times you just take a quick profit if you are not losing, and upward again, market breaks average price and closes above average price, so you bought on the next candle that opens, and of course you took profit, and market again returns to average price and closes above average price, so you bought again, and sure, you took profit on the rejection. Market again tries to approach average price and closes above average price, so you bought again. So now this was your pay in or pay time or pay day of the week, as market finally went all the way up and average price was nowhere near, so you had a position up all the way up and made 51,000, 58,000 points of profit. Okay, so the question will be, if average price is always being engaged, when do you exit a trade that you've held since average price was broken? What are the signs for exiting a trade? So that's a critical question that comes in. So you find an entry, what is your exit strategy? If you've got an entry strategy based on the standard momentum strategy for the week, what would be your entry strategy? So before that could be answered, first note that when trading the standard momentum strategy, your time frame looked at is a H4. That's a 4 hours time frame. So anytime you look at the 4 hours time frame, you are only validating your entry based on the average price of the week. So use average price for the week to validate your entries whenever you are analyzing with the 4 hours time frame, because you're trading the standard momentum strategy. So that's for the week. So now, but if you are trading the other strategies like the minute strategy, your time frame will be moved from 4 hours to 1 hour. 1 hour, and you can learn how to trade the 1 hour time frame also as a mini momentum trader or intraday trader. Okay, so where the micro momentum comes in basically is on determining the first entry for the week. So you can have a balanced bias for trading the week's trend with the first momentum in reaction or engagement of price with the average price. Okay, so now the question, back to the question on when to take when to exit a position. Okay, so firstly, you identify average price. So for your entry, next time you are going to close a position is when any candle makes a low below the average price of any running trade. So let's give you an instance here. Let's come closest to what we have here. Coming close to what we have here. Average price is at 927, and when do you exit? Okay, so this candle closes below average price and you are selling here, and you see a rejection all the way down below its own average price. So that is a quick indication that you can exit. You can exit here when market returns back below the average price of the candle you are trading on 4 hours time frame. You can exit and take profit there, and that gives you the signal for the next trade. So if you want to trade back and forth, you can also trade below average price or above average price you buy on any candle. So what you do on the main candle that starts the week, you also do on every candle to determine where to exit a position. So whenever price moves below the average price of the current candle, you are going to exit your position. So but how do you know where the next candle opens from? Okay, so you held your position on one candle, and you held your position on one candle, for instance this candle, green candle here, with average price at 217. So you held position on this candle and its average price is at 916. So if price moves below, if you are selling, if price moves below it, if you are buying rather, if price moves below it, you know you close on profit. And if price moves below the next candle, you know you enter again. So your entry will be based on the average price of each candles. Uh, yeah, the average price of each candle, and also the average price of the main candle of the week. So every candle has its average price that you use to determine your exit. So sometimes you can exit early, seeing what price decides to do to the candle that closes the day or that closes the time of your trading. Alright, so that is for the mini or the standard momentum trading strategy when trading for the week. One thing that stands out is the average price for the week becomes the factor that determines how price behaves throughout the week. You want to trade where average price is approached once so you can hold position long enough. But you can always exit because of the manipulations in the market. You can always exit whenever a new candle gets uh, to the average price of the previous candle and doesn't reject it. So once it pierces it, you are ready to close on that candle. So, but this happens all the time. All right, so time to go. All right.